Okay, so when you see gold prices jumping around, what do the headlines always scream? Inflation, right? Or maybe market fear. But today, we're going to look way beyond that. We're going to peel back the curtain, because the theory here is that gold's recent moves aren't about the usual stuff at all. They're actually sending a much deeper signal, a signal about the very structure of our world.
And this quote, man, this gets right to the heart of it. Forget the noise, forget the cable news chatter. The real story, the one that actually matters, is being written in silence by some of the biggest players on the planet. So who are these quiet buyers, and what in the world did they see that maybe the rest of us are missing? Let's dive in.
So let's talk about these quiet buyers. And look, we're not talking about your cousin who's day trading on his phone. We are talking about central banks, massive sovereign wealth funds. These are entities that don't think in terms of next quarter's earnings. They're thinking about the next 25 years. And believe me, their entire map of risk looks completely different from ours.
Now check this out, because this slide shows the disconnect perfectly. On one hand, you've got the retail world, right? We're all obsessing over the latest inflation numbers, we're chasing momentum. But on the other hand, these institutions, they're literally stress testing the durability of international treaties. They're not hedging against a bad quarter, they're hedging against the risk of an entire regime failing. It's a completely different universe of risk.
And that brings us to this key concept, jurisdictional arbitrage. Now, it sounds kind of technical, but the idea is simple. This isn't a panicked, sell everything move. Nope, this is a cold, calculated, strategic chess move. It's about shifting your assets to places where the rules of the game are more reliable, or even better, moving to an asset that doesn't have to play by any single country's rules at all. And that's really the bottom line here. When you see this kind of capital moving, it's more than just a transaction. It's a leading indicator. It's the smart money sensing a shift in the tectonic plates long before the earthquake ever hits the news.
So why is this happening? Why is all this capital on the move? Well, the argument is that the very system, the global order we've taken for granted for decades, is starting to change. The old financial models we all learned are starting to crack because the world itself is fracturing.
I mean, think about it. Almost every modern financial strategy is built to handle one thing: volatility. You know, the normal ups and downs of the market. You diversify, you rebalance, you smooth out the bumps in the road.
But fracture is a totally different kind of risk. It's not a bump in the road, it's the road itself splitting into a chasm. Fracture is when the fundamental connections that hold everything together, between countries, between economies, start to snap.
So this is the question we all have to ask ourselves. Every single investment strategy, whether you know it or not, is built on a pile of assumptions about how the world works. But what happens when those assumptions, those bedrock beliefs, just aren't true anymore?
And this slide just lays it out so clearly. You've got two completely different worldviews. If you assume that at the end of the day, global cooperation will win out, then yeah, an asset like gold seems kind of pointless, redundant. But if you assume that things like currencies and trade routes are going to be used as weapons, all of a sudden an asset that sits outside of that entire system, it doesn't just look interesting, it looks cheap.
And all this forces us to rethink what gold's real job is in the 21st century. It's not just some old-school hedge against inflation anymore. Its real value might be something far more fundamental: pure, unadulterated neutrality.
This brings us to a powerful idea called the neutrality premium. It's basically the extra value an asset has precisely because it's independent. It doesn't need a single nation's legal system to be valid. It doesn't depend on a political alliance to have worth. It doesn't even need a specific bank's payment system to work. It just is.
And this matrix here just makes it crystal clear. You look at currencies, bonds, you name it, they are all tangled up in this complex web of dependencies. They need courts, they need alliances, they need payment rails. Gold? It needs none of that. You're not just buying a metal. What you're really buying is total independence from that system.
You know, for the last few decades, it kind of felt like geography was dead. Capital was just bits and bytes flying around the world at the speed of light. But that era seems to be ending. Physical location, control over shipping lanes, control over resources, geography is starting to matter again, big time. And in a world where you are is critical, having a reserve asset that isn't tied to any one where becomes incredibly powerful.
So we've talked about the quiet buyers, we've talked about fracture, we've talked about neutrality. All of this, it all culminates in one final massive idea. Because at the end of the day, the real debate here isn't even about gold. This is the pivot. This is the whole thing. The discussion we're having is not about the merits of a yellow metal. It is an argument about how much you trust the current global financial system to hold together. It's a bet on the durability of alliances, treaties, and promises.
And right now, if you look at how markets are priced, they're implicitly betting that this web of global trust is permanent, that it's a fixture that will last forever. But, just a casual glance at any history book will tell you that alliances, empires, and global systems are never, ever permanent. They always, without fail, temporary.
And this slide reveals the absolutely mind-bending asymmetry of this whole thing. Let's play it out. Say you believe the system is stable, that alliances will hold. If you're right, okay, maybe gold is a little overpriced and comes down. No big deal. But what if you believe the system is stable and you're wrong? It's not just a single trade that goes bad. The entire foundational assumption holding up the global financial system shatters. The downside isn't losing a bit of money. It's systemic. It's catastrophic.
So, I'm going to throw this question right back at you. We've walked through this entire chain of logic, from the quiet buyers all the way to the trust argument. Where does it break down? What's the flaw in this reasoning?
And I'm serious, this is way more than just some interesting academic idea. The answer to that question could literally define how we all need to think about risk for the next decade. So, what's the counterargument? Go ahead, tell me I'm wrong.